Welcome to Lay of the Brand, where we talk with the experts on tech marketing, creative, and PR to learn what's new, what's working, and what's next. On this episode, entrepreneurial dreams are alive and well, but can they become reality in these uncertain times? To land venture dollars, you need to outshine the competition and demonstrate your worth. That's especially true during a pandemic, when in-person pitches, sales meetings, and rooms full of engineers coding into the night seem like relics of another time. But investors are still looking for great ideas and great companies to deliver them, and they're still making funding decisions that could launch the next household name. To find out how entrepreneurs are getting the attention of the investment community, we're joined by Eric Engineer, venture partner with S3 Ventures, the largest VC focused on Texas. He's here to provide a pulse on the market and share insights into how startups can win over VC decision makers. Eric, thanks for talking with us.
Thanks for having me, Peter.
To start, could you give us some background on S3 Ventures and tell us a little bit about yourself also?
Yeah, happy to. As you said, we're the largest venture capital firm focused on Texas. We've been around 14 years. We manage closing in on $600 million of assets under management. We're unique in that we're backed by a single multi-billionaire family. So it's a pretty unique model. We have one limited partner that has funded us over those 14 years. And that really provides a lot of flexibility when you think about the fact that we don't have to go fundraising every few years. We can focus on our portfolio and meeting great entrepreneurs. It also means that the size of our funds and the age of our funds are not limited in any way. We can extend them as needed. And so that provides also more flexibility to do what's right by the founders that we work with, and never doing unnatural things like having to sell prematurely or run out of cash for a certain investment. In terms of stages, we do seed A and B rounds. That means we can write a $250K check into a convertible note. We can write a $3 to $5 million check into leading a Series A. And we can also write a $10 million check to lead a Series B. In all cases, we like to follow on for the life of a company. And in some cases, when companies that are going to pre-IPO and have like larger growth rounds, our limited partner will come in and write some checks as well. So we can really kind of support a company from the very early days all the way to when it grows really large. In terms of sectors, our hypothesis is Texas. We believe in Texas entrepreneurs and the market here. So we're pretty broad in terms of sectors, though I'd say about 2/3 of our investments, the 40-something investments that we've made, about 2/3 of them have been in that B2B software space. But we've also done some consumer digital experiences and some healthcare technology, which includes medical devices as well as healthcare IT. So, if there's software in it, that's probably the secret sauce for us. But we'll look at things kind of that maybe have software components as well.
And what's your background?
Yeah, my background, I joined the firm about 2 years ago. Prior to that, I was CEO at one of the portfolio companies. There's a company called Invoto that was pioneering the use of video in e-commerce. So we take it for granted today that every product that we shop online for has a video of some sort, kind of a feature benefit or a demonstration. That was not the case 10 years ago when the company was founded, when YouTube was just being bought by Google. Retailers were trying to figure out how to get a video on one page, let alone hundreds or thousands of pages in their catalog. So we built a technology platform for delivering those videos and measuring the impact that it has on things like sales and returns. And then over time, we actually added a highly scalable video production capabilities. So think of big warehouse with multiple studios where Home Depot, Toys R Us, JCPenney, big retailers used to send us truckloads of product, and we used to produce it high quality, high scale as kind of part of a full solution for them. So I was running that company prior to joining, and before that, I was at another venture capital firm. I went to business school. I worked at Microsoft for a while at product management, and I worked at a startup called Trilogy Software in Austin. Part of that. I have a computer science background, so kind of technical by nature.
So you've really seen this industry from pretty much every angle, haven't you?
Yeah, both sides of the table, I guess, in that way.
So tell us, Eric, how are VC investment strategies adjusting to the changes in the market thanks to COVID? What's changed about how you're doing things?
Yeah, sure. I think strategically, when you think about venture capital investing, it's a long-term proposition, right? Most of these funds are structured as 10-year vehicles or really thinking about long time horizons. And so we still believe that the fundamental themes that we've always been investing in, like digital transformation of large enterprises, kind of consumer digital trends and adoption that continues to accelerate. Those things still remain true, and in fact are being accelerated in a lot of cases by COVID. But at the end of the day, a lot of companies, especially B2B companies, are selling to customers that may be adversely impacted, financially. They might be going out of business in certain sectors. They might be just cutting back on their budgets, or distracted. And so we've definitely seen situations where, sales may slow down or pause during this period, but in other cases they've accelerated. And, we have companies that are growing much faster than we expected prior to the pandemic. So I wouldn't say it's really changed our strategy. It has definitely started to impact maybe how we start to meet entrepreneurs and develop relationships and partner with them. But overall, I think it is in some ways business as usual. We've continued to make investments throughout this period. But it is becoming more, we just have to adjust to the fact that we can't meet people in person.
Has your pace of investment slowed, or has it even sped up?
Yeah. So, I'd say when you think about just the different phases of what we've all gone through as a society, the first few months, March, April, May timeframe, when everything was starting to kind of hit the economy and hit people's lives, we definitely slowed down in the sense that we started to focus on our existing portfolio, help them navigate the uncertainty. There were government programs like the Paycheck Protection Program, or PPP, that all of these small companies had to figure out, is this something I can take, or should I take? There was a pretty dynamic rules changing, by the hour, it seemed. So we had to figure all of that out and be helpful to our portfolio companies as they kind of, made those decisions. And then they also had to make the decisions around, what is the rest of the year going to look like? Should I make some cuts or furloughs to be able to extend my cash runway, because I don't know, what sales are going to look like, and how much, when I'll be able to go raise another round. So we had those difficult conversations. In some cases, we had companies, have to make difficult choices around layoffs and other things. And others, they were actually seeing things accelerated and they had to make investment decisions. So we spent a lot of time kind of internally focused those first few months. And then as the summer progressed and we all got used to Zoom and things like that, and re-engaging with companies, we started to get into kind of our normal routines of, meeting lots of companies. In fact, I would say we actually have started to, in some ways we meet more, because it's easier to set up a meeting, through Zoom than kind of all the time that it takes to do coffee meetings. You can kind of stack them back to back a little bit more efficiently. And so we've continued to have those conversations, and we've actually made 2 investments, over the summer. So things are starting to pick up again, and I feel pretty good about it. Like I said, there's certain verticals that are growing faster, and so there's a lot of excitement around certain areas that we continue to kind of look at.
Well, the changes that you mentioned, now that you're able to work over Zoom, is that something that you see sticking with even after we start reopening more and getting back to face-to-face?
I think there's just a general comfort level on both sides with everyone, just with a video call. I remember pre-COVID, people would opt, or the default was, if we were going to do something remote, was not video. The default was a phone call or a conference call, all audio with some maybe screen share. And so, the fact that I think that is something that will change. I think video call will be the default mechanism. And then, especially for the introductory meetings, getting to know you type things, I think you can get some of that up front with the video call. And then the second or third meetings, may become the ones that become face-to-face. I would say that, what we don't get in all of this is, at least at S3, there's a period, like probably in the later stages of diligence, where we do sometimes a full day or a 3/4 day meeting to really go deep into a company, where our entire partnership usually goes to the offices of a company and gets to meet most of the management team, walk the halls, get a sense of the culture, get a sense of the, the energy levels and how things are done, and just kind of get a feel for not only the environment, but then also the way that the executive team interacts with each other, and then how they communicate and the like. And we don't get as much of that in a virtual environment. We do the same thing now over Zoom. You get a little bit of that, but it's not the same. And so I hope that we can get back to that. And because I do think that's something that is missing. And we also, we used to also go out to dinner with the founders and get to know them on a social kind of personal level, understand kind of their style, their background history, their, and how we might work well together going forward. Investing is very much like dating before you get married. These are sometimes decade-long relationships. And so you're trying to understand if you're compatible at a personal level as well. And so that is something that is also no longer viable right now. And so we've been kind of trying to find the equivalent way of doing that over Zoom, like a Zoom happy hour or Zoom coffee or something like that to just get to know the individuals. But, I'm hoping that will return as well because that's something that while we're doing that, it's not the same.
What makes a good investment? Has anything changed about that? And has this opened up some opportunities that you might not have looked at before?
I would say that, our strategy hasn't changed too much. So when we think about what makes for a good investment, all those things still hold true in terms of a great team, a product that is solving a real pain point in a very large market, some evidence of traction, that gives us a sense of what stage the business is and if it's, a stage that we are ready to invest in or something that we have to wait to see a little bit more evidence. All of that remains true. It's just now that there's certain different dynamics in different markets. So some markets, the things, those trends have accelerated and we might get more excited about those markets. And then other ones where there might be more uncertainty. If you're selling into restaurants or bars or, or retail generally, there's still a lot of uncertainty, or real estate, there's just a lot of things that there might be some challenges because those verticals or those industries are going through so much change. You may say now's a great time to invest because of that change, or you may say, hey, you know what, we don't know what the future holds. We may have to hold off. So, it's no different than what we've always done in terms of how we analyze things, maybe, but just the individual facts within those markets may be different now. I would also say that, because it's not clear what fundraising environment might look like a year from now, I'd say kind of the conventional wisdom seems to be now you raise a little bit more, maybe, definitely get 24 months versus 18 months. And so there's little things like that. I would also say there's a little bit more comfort with distributed teams than before. As you mentioned in your intro for today's podcast, right? The kind of prototypical having a bunch of people in a small room together, working together, creating that energy is maybe in some ways ideal. But that's not the reality of today. There are a lot of successful startups that have been purely remote businesses. And, I think it's making all of us, at least in our team, a little bit more comfortable with some of those distributed concepts. But we just don't know what the future holds. We don't know if 6 months from now, a year from now, there's some negatives to that we have to figure out.
What verticals are looking most attractive to you right now?
So, what we're finding, we in fact, have had companies in our portfolio where their sales have tripled compared to what they planned in January pre-COVID. So like it's like they're 3 times their plan. We also had a company get bought, over the summer by DocuSign, and I think maybe some of that acceleration of that acquisition may have been due to COVID, and it's because the reason I mention those things is because what's really exciting to see is a lot of this digitization of certain workflows or ways companies engage with customers, or the way they do training, the way they collaborate, the way healthcare is delivered. All of these things, the digitization of certain industries or certain parts of business is just accelerating. Things that people were saying, okay, I'll maybe try to do in the next 2 years, they have to do now, or they were forced to do now. And so that's huge, right? That totally changes things. And when you think about a startup and you're, every month counts, you're raising money for the next 12 to 18 months and are trying to hit certain milestones. And if suddenly things get pulled forward, even by 6 months, that's huge in our business. So that's really exciting. So when anything that, we find that, if the customer base that they're selling into is still solid, if you're selling into healthcare probably right now, or into other technology businesses or into financial services, those all look pretty vibrant. And so you don't have that risk that your customers can't afford you. Those all feel like good bets.
Well, let's talk about what these startups then need to do to get the attention of investors like yourself. How are early stage companies getting on your radar?
It's a lot of the same, and some of it is different. So I would say what has gone away right now is we don't have all the entrepreneur startup events, whether it's happy hours or panels and other things, or even like these big summits or, annual kind of get-togethers that a lot of cities put together. Those things have been postponed or gone all virtual. And in either case, the ability to kind of just network, while there are some ways to enable that virtually, and I'm seeing some really creative ways of doing that, it's still kind of not the same, frankly. It doesn't really get us there. There are some kind of matchmaking things where investors get matched with startups, which still work well virtually. And, I'm grateful that people are still doing that. So we can continue to meet people those ways, but, the kind of, I'm just going to meet someone at a happy hour, that doesn't happen anymore. But anything that's digital still works really well, and in some ways might be work better. So, LinkedIn is tried and true. I'm still pretty responsive on LinkedIn. I just ask that people, when they add me, they actually add some context in their invite of why they're reaching out. If it's just a regular ad, I'm probably not going to necessarily respond unless it looks interesting. But context always helps. But I think reaching out through digital channels is still fine. In some ways, because there's less travel, I'd say investors maybe have a little bit more time. If you think about it, they're not commuting every day, and they're not getting on planes to do board meetings and things like that. There may be fewer coffee meetings, so less time in the car. So just more time to maybe, let's schedule a 15-minute quick intro or 30-minute quick intro, even if it's not very clear whether it's a fit or not. And then there are always junior people in all of these firms whose entire job is to kind of find new investments. So I think that's still very healthy, and people are still accessible. It's just kind of in the digital realm.
Since these channels are limited because of this, how can companies seeking VC investments actually stand out from their competition? Is there anything that makes them jump out to you?
Well, I think the reference, definitely, like if we get referred from a trusted source, whether that is, a law firm around town that works with early stage startups, some of the partners there have, are definitely very trustworthy individuals that know how to kind of show us businesses that they think are of high quality. And so, we always take those meetings, and it could be it doesn't have to be the lawyers, but it could be other folks in the ecosystem that refer us business. It could be an angel investor, it could be another seed fund, so those warm introductions always kind of take precedent, I would say. And then, if it's clear that a company has a very unique team that is having really great traction in a big market, like I said earlier, and you can demonstrate that or communicate that to us in that outreach, very succinctly, that's important. It could be also through your, I'd say, we have a team that does a little bit of outbound efforts, in the sense that they are looking at funding announcements in the press, or other articles that might be written, or anything that kind of pops up through digital channels, in LinkedIn. They're on the lookout for things that look interesting. And so if you're able to kind of communicate your story broadly, maybe it's through those digital channels or through referrals, we kind of get wind of things that way.
Are there things that the marketing and PR folks at these early stage companies shouldn't do to get your attention?
Well, I think gimmicky things, I would focus on real metrics, I guess. So one of the things that I think can lead to disappointment, how about this, is not, focusing on vanity metrics or exaggerating things just to get the meeting, right? And that, whether that's marketing or in the CEO's outreach in the email even, right? But what I found sometimes is that, and this is like a lesson in life, right? Like expectations are everything, right? So if I come into a meeting with certain expectations, and then I find out that those, that revenue level is really not what I thought it was, or, this big customer you said you had is really like a proof of concept, and like all those kinds of things that are downers, because I came in hoping, or this, thinking that it's something and it's not, that doesn't really kind of make for a successful first meeting. Much better, I would say is transparency, and very clear that, okay, this is where we are. This is the stage that we're at. We're used to things being messy. We're used to things being not perfect, and not and still early in terms of traction. That's not a bad thing. It's just where you are, and that's fine. And so the big thing for us is, I think like revenue, for instance, recurring revenue is important to a lot of the SaaS businesses, but you'll find that sometimes people will lump in the certain one-time services revenue in this number to like as a headline number, and then you kind of deconstruct it, and then it's not really at the stage that they proclaimed, or one-time pilot revenue, or proof of concepts with the big companies that really, you've talked to one guy once, and so, so all of those things, if you're kind of inflating things in your outreach, that's also bad. So, even though it's important to talk about those things and show traction, exaggerating it doesn't help anything.
So what's changed then about messaging for these companies when they're getting started with you or once they've ramped up? What can marketing and PR do to help build the relationship with you and also expand out into the market?
Like I said, the funding announcements and stuff like that are helpful. So, even if you do a seed round with angels or things like that, you making sure that you're at least being picked up by some of the lists that announce things is good, because it gets on our radar. From an outbound communication standpoint. But I think more importantly, it's about just actually help. The most important things that those companies can do is just have traction, right? So I wouldn't have my marketing people focused on my investor relations, right? What I'd have them do is just make sure that, that you're winning customers and they're happy, and in some ways the customers are then amplifying and supporting your marketing, so you kind of are growing faster and you have happy customers. Because a lot of what we do, as part of our diligence, is to talk to customers or potential prospects, people who you've not mentioned, but we think are in your market, and say, have you heard of this company before? When you go to your website, go to the website real quick. Tell me what you think about it. Well, if the website doesn't tell the story very clearly, when we're doing that diligence, then we might get some bad signals. And I think, when you think about an early stage business generally, and this is not about investor outreach, but more generally, like what the role of, marketing is in those early days, it's really, I think, more about if you're going to have marketing people or marketing skill sets, it might even be the CEO or the head of product doing this. It's really product marketing. And it's really being able to very clearly articulate, the messaging for the different personas and segments and being able to have a very clear position. And that's important for fundraising too. If you're not able to communicate as the CEO, what is that clear, unique position? What's that unique way of seeing the world and the opportunity that no one else is seeing, and how you're addressing it, whether it's through the product and or the go-to-market. If you can't very clearly articulate that to an investor, then I think it's going to be challenging to fundraise. And if the CEO, let's say it's a technical founder, right, and technical CEO, so where like the business or the marketing co-founder or hire can help, is making sure that messaging is very tight, even in the pitch deck, right? One of the things I would also say is, don't take your sales deck and I think that's your pitch deck, right? The pitch deck, the investor is a different audience. So if you don't, as a founder, have that skill set, I would lean on people on your team or your advisory group, your board, whatever, who can help you articulate and tell that story very clearly, succinctly. That's a big role that is not outward facing. It's not something that you might see, on social, but is it's an important role that kind of marketing type exec can play in the early days.
Well, let me open this up to you, Eric. Any last thoughts or takeaways for us?
I would just emphasize that, in today's world where we can't meet face to face all the time, and we don't have the opportunity to have a lot of those social interactions as part of this kind of almost like a mating ritual that happens, over, a 6-month or a 12-month period before we make an investment sometimes. It's important that in those meetings, especially during these meetings that are as part of a diligence process, that, a lot of those meetings should not just be about, let's just run through the deck. It's about getting to know each other. I would actually space out the meetings, even if they're 30-minute meetings, to make sure that those first 5 minutes are a little bit of chit chat, right? Your small talk, where you get to know each other, you get a sense of who the other person is, and you can find ways to connect with the individuals at the beginning of these meetings, and take the time to do the intros, because you don't get to do that I mean, those are things that naturally happen in face-to-face meetings that sometimes get left out. I've noticed in these Zoom meetings, people just kind of jump into, let's look at the deck. And so that is a piece of advice I'd give folks.
Well, it definitely is a human-to-human connection that has to be made. Because, as you said, this is almost like a marriage. It's long-term.
Mm-hmm. Yeah, absolutely.
I've been talking with Eric Engineer, venture partner with S3 Ventures of Austin, Texas. Thanks for being here, Eric.
Thanks, Peter. It was a lot of fun.
And thank you for joining us. Lay of the Brand is brought to you by Merit Group, an integrated strategic communications firm that blends the best of PR, marketing, and creative to help our clients tell their stories and build business. Got a topic suggestion or want to share feedback with us? Subscribe to Lay of the Brand on your preferred listening platform and leave us a review. And please spread the word and tell your friends and colleagues to tune in as well. To learn more about Merit Group, check out layofthebrand.com.